Today, I'm going to start off with some background about what's going on with economies in Asia. And from that point, we'll then move into patterns of entrepreneurship in Asia. So if you look at the largest 5 economies of the world, the US is still the world's single largest economy. If you included the European Union as a single economy, they would come in number 2. But next to the U.S. in terms of individual, countries is the People's Republic of China, then India, then Japan, and then West Germany. So what you see here that's kind of interesting, I'd like to point out, watch the growth rates. This is all purchase power parity calculation. And I'm going to give you 2 different views of PPP calculation. One by the CIA World Factbook, which is this one, and the other by the World Bank, because they'll be differing by a few $1 trillion. And anyway, notice that the growth rate for the world economy went down from 3.8% to 2.8% in 2013. It's supposedly going back up to about 3 or 3.5%. Historically, for the last 50 years, it's been about 3.6% a year. So we're still kind of starting to come out of a downturn. With regard to the United States and Japan and West Germany, we're below the world growth rate. But we're also considerably higher than the world average in per capita GDP, which is basically income, right? Notice that China and India are both considerably above the world growth rate, but their per capita GDP is lower than the world average. That's not unusual. You tend to see economies that their growth rate slows as the economy gets bigger. So this is what the CIA tells you for recent growth rates, recent size of the world economy. US $16 trillion, China $13 trillion as of 2013. Now, if you look at that with what the World Bank gives you, you see that the World Bank's calculation puts China up at $16 trillion in 2013. 3 trillion, right? Give or take a little bit. But notice this is what people are all excited about with China, right? This is the amazing growth rate over the last, really, ever since Deng Xiaoping. And what we've had for the last couple of years, since 2013, is a marked slowdown. The growth rate in the China economy was close to 10% a year, every year. And then beginning in 2013, 2014, it has dropped down to around 7%. And so that's one thing to watch out for. Now, to really look at Asia, we should look at the other 10 Asian economies that fit into the largest 50 economies in the world. I'm leaving out Middle East countries in this, but there are really 10 other Asian economies that fit into the top 50. Conveniently, South Korea in the year 2013 exactly matched the world growth rate. So that's why it's green, okay? Everything else is either, if it's in blue, it's faster than the world growth rate, or it's lower than the world growth rate. Now, this is back to CIA World Factbook figures. Notice the size of the Indonesian economy. Indonesia and South Korea are the only 2 other Asia economies that are already trillion-dollar economies. And CIA conservatively estimates Indonesia to be $1.3 trillion in size. The World Bank, however, gives you a much more aggressive, I guess you could call it aggressive, calculation of Indonesia's GDP, which is really $2.4 trillion. So look at Indonesia. Nobody talks about Indonesia, right? And yet Indonesia has had a steady growth rate for the last 10 years, and it's a much bigger economy than just about anybody else. South Korea is 1.6 trillion, 1.7 trillion. There are more than 100 million people in Indonesia, right? If you go back to the CIA figures, you see that the average per person gross domestic product in Indonesia is $5,200, whereas you have a much higher number in South Korea, in Taiwan. In general, the places that have higher than world average per person GDP will have lower growth rates. So in more recent years, the world is starting to pick up. We're seeing this in the US, and I do want to mention just some special situations before we move on. First of all, there have been some incidents that have been bad enough to have noticeable direct impact on the size of economy, the economic growth rates. One is the big earthquake and tsunami in Japan. One was the floods in Thailand. The coup in Thailand, or the worry about the coup in Thailand last year, was already starting to have an impact on their growth rate. Germany has been real low growth rate for the last few years, but that's actually not that unusual ever since the country reunified. Around 0.91% growth has really been what Germany has had for the last 20 or 30 years. It really picked up after the 2008 Lehman shock. Germany picked up and had 2 or 3% growth rate. One other thing that's worth noting is the drop in oil prices last year. Really hit exporting economies that export oil. So that's been an issue. Now, if you look a little bit more specifically, you see that there's a big trend among what I would call the jumping off points to China. And this has to do with concern over what would happen in China as the economy slows down. So back in 2010, Singapore had like a 15% a year growth rate, and it dropped like a rock down to 1 or 2%, depending on whether you're, how you're calculating the growth rate of the economy, $2,002, $2,003. And Taiwan also had a drop from 10% down to 1 point whatever percent. Inside the People's Republic of China itself, there was a 44% drop in venture capital investments in 2012. So everybody slows down, waits, watches what's going to happen, and so now you're starting to see the uptick again. Now you're starting to see more confidence in how China is going to manage its economic slowdown. Especially Hong Kong has been very aggressive in establishing itself as a convenient place to do China business. The liberalization of the renminbi, so that you can trade actively renminbi in Hong Kong, is starting to have an impact. Singapore has also been very aggressively doing its own investments in advanced technology. The government of Singapore has some major programs in biotech, in other kinds of areas that are allowing it to keep a relatively aggressive growth rate. And one reason for the slowdown, as bad as it is in South Korea and Singapore, has been, the general slowdown in Europe. It's harder to sell there. So that's one thing that you notice in these trends. The final thing that I'd like to point about general trends is that Southeast Asia and South Asia are growing steadily and doing actually much more exciting than you would think about from what you hear on the news. You don't hear about them nearly as much on the news as you might think. Partly, the lower cost economies in Southeast Asia are becoming low cost alternatives to China, because in China, the East Coast cities are getting to be very expensive. The average GDP per person across People's Republic of China was about $9,800. The average per person in the big East Coast cities is more like $19,000. So they're really, it's, you know, where do you go? Do you go to the interior of China, or do you go down to Vietnam, or do you go down to one of the other Southeast Asian countries in order to set up your Asia outpost? The domestic market growth has really been what's been fueling these Southeast Asian economies. Some of it is still what I would call developing economy phenomena, namely infrastructure rollout. Thailand is building a big railway system right now. And so this kind of thing, you know, is spending that really does help push growth along. China's engine of growth a few years ago shifted away from infrastructure build out to being consumer driven. So the real industry sectors that are growing fast in China now really have much more to do with consumer spending. India, the World Bank at least is very positive that India is coming back up to around 6.5% growth. And another country that deserves special mention is the Philippines. People don't talk much about the Philippines, but it's actually got a very robust software industry, and it's doing a lot of business process outsourcing. So that's kind of where we are in terms of where the economies in Asia are. What does this mean for entrepreneurship? Okay, I'm going to present material from the Global Entrepreneurship Monitor for the next few slides. This is a huge survey that's done every year. They survey about 200,000 people in over 90 countries and come up with rates of entrepreneurship and attitude toward entrepreneurship in these different countries. Each country has its own team, but they have a very tight control in the central organization that if the individual country teams do not show sufficient care in how they collect their data, they don't report the data from the country that year, and we'll see some gaps in what we look at. One of the things that they have done is they have given us the T rate, which is very nice for Asia, but what it stands for is total early stage entrepreneurial activity. And essentially how they define T rate, look at this process. You've got a potential entrepreneur, that's not included in the T rate, but when that person starts to be involved in actually setting up a business, or if they are running a business that is less than 3.5 years old, meaning it's paid a salary to somebody for up to 3.5 years, they fit into this definition of the T rate. I kind of like this graph because either they stay running the company or the business is discontinued. It may be bought by another business, it may fail, something may happen, and if that happens, then this person may come back and become a potential entrepreneur again. Keep that point in mind because the Valley works very much on this continual flow of people from project to project, right? So the T rate in the United States over the last, 12 or 13 years has risen to 13.8%. This is actually quite robust for an economy that's as advanced as the United States is. Think about the alternatives to being an entrepreneur. Generally, people don't become an entrepreneur in the United States because they have to, whereas in other economies, you may become an entrepreneur if there are no salaried jobs that you can apply for. There's a noticeable drop in the rate of entrepreneurs in the population around 2010. Everybody gets conservative after an economic downturn. Now, they didn't get nearly as conservative as the investors did. There were probably a lot of people who wanted to be entrepreneurs, but to actually be setting up a company or, you know, you kind of got to have some money. So that's the US. There's our baseline. There are about five Asian economies that have higher T rates than the United States does. First of all, look at the volatility. I'm amazed at the situation in China where you go from 24% to 13% and then back up to 15.5%. The situation in Indonesia looks like a really high rate in the year 2013, and then it dropped to just above the American rate in 2014. The situation in Thailand looked relatively uninteresting, 18, 15%, but then it jumped up. Last year it was 23%. Of all of the people between 18 and 64 years old who are either starting a company or running a company that's less than 3.5 years old. So this is a kind of trend that you see. So 5 countries with a higher T rate and 6 countries or so with a lower T rate than the US. The volatility is remarkable here too. So this is India. Way back in 2002, India had a 16% T rate and then dropped to 10, 11%. Then Global Entrepreneurship Monitor would not accept their reports for a few years. They showed up again in 2013 with a 9.9% rate and then a 6.6% rate. The next one down is Singapore, which has gone from down at 6%, 4.8%, and then has jumped back up to 11%. Taiwan, with an 8.5% rate, has been relatively steady for the years that they've looked at it. South Korea has, where did South Korea go? South Korea is this one. They didn't take South Korea's numbers in 2014. So South Korea has had this relatively stable rate at 7 or 8%. And Malaysia dropped like a rock from 2006 to 2009 and then has stayed around 6%. And the low people on the totem pole is Japan, right? 3.8%. So what's going on? The first thing you can see is that the countries with a higher T rate than the United States all have relatively low GDP per person, right? They're all still relatively developing economies. So that's not surprising. The countries with a lower T rate than the US are kind of harder to figure out. I frankly was very surprised to find the relatively low T rate in India. That just doesn't make sense because you would think that there would be an awful lot of people who had to be entrepreneurial in a rapidly urbanizing and rapidly developing economy. Similarly, I felt that way about Malaysia as well. With Japan especially, yeah, that's good. Everybody talks bad about Japan, that Japan's T rate is so low, and Japanese entrepreneurs have, such a terrible idea about there not being opportunities for entrepreneurs. We'll come to that in a few minutes, but you would have expected somewhat of a higher rate. Global Entrepreneurship Monitor has taken this general trend of how many entrepreneurs you have in an economy along with the stage of economic development. And they've given you a very nice smiley face graph out of it, where at lower GDP per person, you get a lot higher rates of entrepreneurship in the economy. So China that year was 16% CN. Japan is down here, even below the rate. UK is there, Netherlands is there. Hong Kong was a high rate that year, and the US was quite high rate, above the world average. What's going on? According to their analysis, you have 3 stages of economic development. In the 3 stages of economic development, one is what they call factor-driven. That's a developing economy. The second stage is really efficiency-driven. After an economy has developed domestically, some of the companies that grow large during that first stage will globalize. That tends to be an efficiency-driven economy because those big companies control a lot of capital. They have the most prestigious jobs. People want to work there. Those kinds of countries typically have a low T rate. Then you see a somewhat increase in the T rate in an economy as the per person GDP continues to grow higher. And this is because a lot of people are not satisfied with a job in a big company. They think they can do better for themselves in a more advanced economy. So there's a lot of social things that go on in this sweep of development. First of all, it is true that at this stage, typically there are fewer big companies you could work at. So the chances are that you're going to have to be an entrepreneur is higher. At this stage, though, a lot of the people who work for big companies, their children don't want to do what their parents did. And the parents would like to see the children have better opportunities than they did. So a lot of it has to do with the spread of education through the economy. It has to do with the skills that are demanded of people who have college educations. You can get a great job working in a factory with a high school education. But if you've got a college education, you typically want something better. So GEM also has this kind of thing. I want you to look at the percentages. According to them, in a factor-driven economy, about 30% of the people who are involved in T activities are that way because of necessity, and almost 50% are that way because of seeking better opportunities for themselves. In the efficiency-driven economy, about 30%, a little bit lower, somewhere around 46, 47%. And then in the innovation-driven economies, you really see people after the opportunity. All right, that's what they published. I went back into their data and took a look at it, and all of the Asia economies we're looking at are incredibly opportunity-driven. Now, this is reported by the people who took the survey, so maybe they didn't want to admit that they had to become an entrepreneur, okay? You've got to recognize that there's that possibility in the survey, but the ratio of opportunity-driven people, even in the factor-driven economies, is over 58%, right? 56, 57% is the lowest, and you get, up in the 70 or 80% range for quite a lot of the people there. In what they group as efficiency-driven economies, the ratio is still that high, and of course in the advanced economies, it's also very high ratio of people who are driven by opportunity. So that's not that different between Asia and the United States. And if you think about it, the process of starting a company may be relatively easier or harder in a particular economy, but the similarities are much greater between Asia and the US on the creation side than it is at the growth and exit side. It's at growth and exit where you really see differences between these different economies. Let's take a couple of minutes and look at Silicon Valley as a baseline. One of our speakers this quarter talked about how many companies there are in Silicon Valley and how everybody's involved in starting a company in Silicon Valley, right? I ran into this very interesting graph, which is great because you can't see any pattern. Essentially, Silicon Valley is one of these lines, and the dotted line is the average of innovation centers, urban innovation centers in the United States. But if you want to know who really had more startup companies per 100,000 people in the population, it was Orlando, Florida. Okay, so, yep, published results. And so I think that yeah, right. I wonder if Cinderella does count in that. Anyway, innovation centers look like innovation centers. It's very similar here than it is in other places inside the United States. So what makes Silicon Valley different? We've got our famous entrepreneurs, but the reason our entrepreneurs are famous is because every 7 or 8 years, Silicon Valley will be dead center in the middle of a major new wave of industry. A major new industry will appear. often based on some disruptive innovation. And the point is, we will have one or two companies that become world-leading, multi-billion-dollar companies out of this phenomenon. If you really look more recently and do a more detailed analysis from the early 2000s on down, you've got the Web 2.0 era in the early 2000s, and you've got social networking. Built on social networking, you've got big data analytics. Built on big data analytics is new types of big data. IoT is on the horizon. So you really see companies that are coming out of each one of these. Cloud computing fits in there, right? Cloudera. That's what Silicon Valley is famous for. And this is one thing that you haven't seen in Asia yet, except for maybe Alibaba. So I wonder if with Alibaba and Tencent and these companies from China that are really shaking up the world, you're seeing the same thing but delayed by 10 years, right? So that's kind of an interesting pattern. If you go a little bit further, how companies are started up. In order to start a company, it takes people, it takes an idea, and it takes a little bit of cash, it takes some money. So what you have to have in order to create a company, to have a system, an entrepreneurial ecosystem, you have to have sources for those three elements. You do need an infrastructure, but you also have to have the right kind of dynamics that sort of encourage them to move into a new combination. So this means that if you want to compare entrepreneurial ecosystems, on the people side, the people that found companies, yes, you do look at the demographics. They may differ, not only in terms of age, in terms of gender, but also in terms of the background expertise. Are more entrepreneurs technical, or more of them coming out of a business environment? You do have sources of the team can be either existing companies or universities, or it could be founding entrepreneurs going back and becoming a serial entrepreneur. You've got the dynamics for that really have to do with the mobility of the labor market, and that in turn involves a lot of factors such as the social attractiveness of being an entrepreneur. One time I was addressing a group of Asian students about entrepreneurship, and so I asked, why do you want to be entrepreneurs? I got this blank stare, and finally one young woman from South Korea said, for the good of society. And I thought, okay, I wonder how many people at Stanford would have answered that question that way. Anyway, the career cost of failure is a dynamic that will either keep you in your current job or encourage you to start a new job. On the idea side, you've got the sources of the ideas. What you're really looking at is perception. Entrepreneurs do what they do because they think they have a market opportunity and they think they can access that market opportunity. So that is very highly indicated on perception. You get a lot of stuff from Global Entrepreneurship Monitor about these attitudes that I'm not going to share today. You can look at their report. It is quite interesting. Tech transfer, knowledge transfer is a big part of how the ideas come into being. Sources of capital, costs of capital, conditions for capital. One of the big issues in a lot of Asian economies is the issue of personal guarantees. There's a lot of debt financing outside Silicon Valley. And you go to a bank and you take out a loan to start a company, and you must sign personal guarantee for that loan to your startup company. Meaning, if the startup company doesn't do well, they take your house, right? And I do have to say, this is not only in Asia. I got burned that way in Georgia, so I know what that's like. Anyway, then you do have this kind of other category of infrastructure, which is the legal system, whether case law is interpreted consistently or not. the whole existence of mentors who are not really part of the company, but who are good personal advisors to the entrepreneurs. The whole issues with corruption is basically an infrastructure issue that a company has to deal with. If you're really going to do a thorough comparison across countries, you have to look at all of these elements of the system. Yeah, we'll come back to this, but notice that the founding team really is key at this stage because they will be the direct source of the idea, and they will be the direct source of the first capital. They possibly, after hitting up their family for some extra cash, will be the first source of capital for the company. So that is pretty universal. Where you really get a difference is in the patterns of growth. If you look at a startup company, it will go through 3 distinct stages of growth. The first stage is really this idea stage. The second stage is a prototype stage. And then the third stage is the product stage. So what you see in Silicon Valley is as rapid growth as quickly as possible, with the idea that eventually, once you've got a product out in the market and your company is well valued, you're going to exit. And you will exit in one of 2 ways. You will either be bought by a big company or you'll go IPO on the public market. So what you see is a gradual shift from the founders, who own almost all of the company at this stage, to the venture capitalists and others who really own the majority of the company by the time it goes IPO. Most American companies at the time of IPO will have an ownership structure that's basically, before the public stock is sold off, maybe the founders will have 10 or 20%. The venture capitalists will have the biggest share, which may account for why a lot of times founders are no longer running their own companies. And then they'll sell, a third or a half of the available stock in the company on the public market. In Asia, you get a pattern where most entrepreneurs hold on to much larger shares of their company, so that even after the company's sold on the stock is sold on the public exchange, a single person will own 50% or more of the company. It's kind of like a public company, but yet it's not. And so you do get drastic changes. If you really compare what you have to look at, you do have to look at the accessibility of workers separate from the entrepreneurs. This is something nobody talks about when they describe Silicon Valley. We're such a wonderful place of entrepreneurs. The vast majority of people in Silicon Valley are not in the process of starting a company now. But you sure have a lot of people working at companies growing 100% a year. Rapid growth companies, do you want to call Palantir a startup? Do you want to you can't call Google a startup anymore, but you have people who are accessible in new companies that are establishing their own prestige. You also have, on the people side, attitudes of manager-investor relations. So I mentioned the investors who will get rid of the founder manager of the company and put in a professional manager who has industry experience or something. You have a churn rate that here involves not only the workers and the founders, but whether they see it as a good thing to stay in a company for 2 or 3 years and then jump up to a better job in another company. With regard to the ideas, you do have facilities for prototyping, and also, I think the biggest thing about the idea side, if you're comparing companies, when the idea is now a product, then the real issue is market access. And you need to look at that not only in consumer markets, but also when you need B2B kinds of activities, even channel sales for a consumer product. Capital, you've got, the sources and the conditions for funding. You've got patterns of valuation that you can compare. You can compare the changes of ownership. And then finally, you can compare the different kind of exit patterns. So here's a case example. Here's a case study from Silicon Valley that I think is classic Silicon Valley in many ways. So Square. Square really started in 2009. Or sometime around 2008, 2009. Why did it start? Jack Dorsey had been fired from the board of Twitter. He was CEO of Twitter, and the investors decided they needed somebody else. Jack had a lot of money. Jack had some time. So he got together with some other people and founded this crazy little company, Square. We don't know how much of his own money he put into it. The first time they showed up in the news was in November of 2009, raising their Series A venture capital money, $10 million. That was a big valuation in 2009, right? Remember 2008 had happened and investors were not investing in anything and they managed to get $10 million in their first round? Okay, that's pretty impressive. The other impressive thing is they started their service within 6 months. As fast as you can go, right, is the general speed in Silicon Valley. And as soon as they started their service, they started getting revenue, but that meant that they're just going to get their next round of venture capital as quickly as they can, about 13 months after their first round of venture capital. Then they, by this point, the news reports that they had processed about $1 billion of payments. If you figure how much money they keep, it's generally around 1%. Because they have to pay the credit card fees out of their 2.75% commission. So if you figure that they processed $1 billion of payments, they probably had about $10 million of revenue that year. But you don't sit back and just say, wonderful, we're a profitable company. You go out and raise another $103 million. They actually did this in 2 rounds. One round of $100 million, but they let Richard Branson invest $3 million later. They were very patient with him, and they called it Series C, but it was 6 months later, December of 2011. By this point, they've got 150 people they're paying on this, right? This is one reason you have to grow as fast as you can. By 2012, they were 4 times as big. So $8 billion, $80 million in revenue, somewhere around that. So they raised $200 million. At this point, Square is growing so fast that they had a market cap they had a valuation that was probably somewhere in the neighborhood of $10 billion. If anybody wanted to buy Square in 2012, early 2013, they would have probably had to pay at least $10 billion for Square. Whereas things got kind of not so good. They had to, a round of debt financing in 2013. They also just raised $150 million of Series E venture capital last fall, 2014. And so far they have raised almost $600 million of funds from investors. At the same time, they probably have revenue of about $500 million out of $30 billion of credit card payments that they've processed. Why do you keep raising money? First of all, they did talk to people about going IPO in 2014. And the discussions did not go so well because it was looking like their business was starting to be squeezed by some other groups, other people. Does the word Alipay mean things to people? So, Square may get squeezed in the world market, but they are growing as fast as they can in terms of numbers of people, and they are definitely thinking about maximizing the valuation of the company at the time of exit. That is a Silicon Valley attitude that is not necessarily shared in other places. If you look at how the investors see exits, the venture capital industry in the United States has gotten real clever. After about the year 2000, they've decided that you can do a better business as a venture capitalist by growing your company for merger and acquisition rather than by relying on IPO. So now we have about 9 M&A exits for every single IPO exit in the United States. In Silicon Valley, the number is about half of the total of the United States. In 2012, there were 210 M&A exits from Silicon Valley and less than 20 IPOs out of Silicon Valley. So it's interesting how this has become what's really going on in our system. There's one other thing that we need to look at in terms of understanding why entrepreneurship works differently in Asia, and that is that American big companies are looking for disruptive ideas from startup companies on the outside. So those of you who've heard me give this talk a number of times know that I've got a case study of Google about this, right? So we looked at Google, and in the year 2011, Google's internal research and development activities accounted for $6.2 billion. That was 13.1% of Google's revenues that year, and it really average for software industries is 13.3%, so that's pretty normal. But that year, Google paid $12.5 billion for Motorola Mobility. They wanted what Motorola Mobility had right then. The patent portfolio that Motorola had was essential to their Android phone right then. That's why you spend twice as much as your total R&D budget buying it. Last year, Google bought Nest for $4 billion. When you see a major acquisition like that, it's either a repositioning of the company for strategy sake, but whatever it is, it's a business decision for the market right then. In 2011, Google also bought 24 startup companies. After 2011, they stopped making these reports. It became harder to find this stuff out. We estimated that they spent about $700 million buying startup companies in 2011. About half of the instances were actually listed, and the other half you kind of figured out how many people the startup company had and all this other kind of indirect evidence. 10 or 15% of their company internal R&D budget, the equivalent of that amount, would go into buying ideas from the outside. They're not going to buy something that will be a net loss on their books for more than a year or so. So typically, you see companies buying up other companies really within a year of whatever this startup company has going to market. They're buying not just the technology, they're buying the people and the market knowledge, the business knowledge that those people also bring. In 2011, Google spent $100 million doing corporate venture capital investments. And by our estimation, Google spent about $30 million in 2011 in all externally funding research at universities worldwide. So what does this mean? It means that the closer you get to market, the more expensive it is. And the further away from the market that you get, the less you are buying control over some business activity, and the more you are paying to be part of something that unfolds or is evolving. So the situation at Google is a real clear idea of how the companies here in Silicon Valley participate in the Silicon Valley innovation system. Not just buying companies and so forth, but they interact actively with startup companies. They buy products from startup companies. They'll be reference customers for startup companies. And that's a very important function that these companies fulfill in our system. Now, if you start to look at Asia, I want to look at the capital first. We'll start capital, and then we'll talk people, and then we'll talk ideas. So there's friends and family money everywhere. That seems to be universal. Most Asian economies, if there is a break in their pipeline, it's not at the VC stage, it's at the angel investor stage. Between friends and family money and venture capital money, there is this really awkward time when you really need professional investors who have control over hundreds of thousands of dollars. And that tends to be the gap in just about all of the major Asian economies. Venture capital is really on the up in Asia. Well, I've got some slides on that. But what you do see is you see a lot of kind of financial industry decision making, as opposed to the venture capitalists here who are much more oriented to the entrepreneur side and seeing value in crazy ideas here. In the exit patterns, it's a huge difference between Asia and the US. While it's 90% exit by M&A in the US, reports that I get from investors in Japan and in South Korea is that 80 to 85% of all of the successful exits there by venture-backed companies is through IPO. And the size of the IPO is very different. Typically, companies raise much less money in IPO in Asia, and the entrepreneur holds on to a lot more of it. So Ernst & Young does a real good survey of worldwide venture capital every year. Notice that of the venture capital, and this is not angel money, this is venture capital money, the US accounted for most of it, right, in the year 2013. And next to the US was Europe. Israel, $1.7 billion invested, $1.0 billion invested in Canada. China accounted for $3.5 billion of venture capital investments. And then finally, India accounted for $1.8 billion of venture capital investments. But let's look a little more deeply at some of these selected Asia economies. In China, the amount of money that people raised, that the venture capitalists raised, dropped like a rock because of the slowdown. Investors are not going to put their money into high-risk investments when you don't know what's happening in the economy. The slowdown did not happen nearly as much in the amount of money invested. It went from 6.1 billion in 2010 down to 3.5 billion. That's okay. It's a lot, but it's not as much as the drop from 22 billion to 2 billion raised, right? You do see a relatively large size of investments up until this point and kind of shrinking size of a round in China. One thing that I think is positive about that is that in the old days, when you see these rounds around $10 million of money raised, those are not Silicon Valley style startups. Those are large factories that people are putting together. I remember hearing that American venture capitalists who went over to China started investing in milk carton factories, in chocolate factories, because candy consumption in China was going up 60% a year. You invest in what makes the money, right? The interesting thing that happened in regard to exits in China is that IPOs used to be by far more than M&A. But for the first time ever in the year 2013, there were more M&A exits than there were IPO exits. So China is becoming, I think, more sophisticated. I don't think you need to have a 9-to-1 ratio like we do in the US, but it's good that there's more of an M&A kind of option for companies to exit at in China than there used to be. If you look at India, you see a very similar drop like a rock in the amount of money raised. They raised $500 million of venture capital money in 2010, and they raised $10 million, $11 million of venture capital money in the year 2013. Ouch. That's a huge drop, but they are continuing to invest a relatively robust amount of money from money that they raised years before. Has to be. I think you are also seeing more angel investment money coming in from overseas into India. So it could be that some of this 1.8 billion was really foreign venture capital that doesn't fit the amount of VC raised by those same funds. The size of the round has also shrunk in India, which is interesting. And India has the most robust M&A kind of ratio to IPO that we see among these countries that we're looking at. And it's relatively been kind of consistent that way. Companies are not going IPO in India, and I'm not really sure why. I'm not sure if this is something that people are concerned about, or maybe it was, this was pre-Modi, right? So it could be that the current administration in India is making it much more safe feeling to exit. Now, in Japan, you see a real uptick from the real low downturn in the amount of venture capital money. Right now, this is the amount of funds invested. This is not the amount of funds raised. So somewhere between 1.1 billion and 1.8 billion dollars, depending on how you count the yen-dollar exchange rate. They calculated it 100 yen to the dollar, and it's now more like 120. But the pattern is relatively clear. You see a definite uptick in recent years. I wasn't able to get the data on exits in Japan. My sense is that M&A is really picking up. But it's not the kind of open innovation M&A that, say, you see with Google buying up startup companies. It really has to do with companies that have assets that are worth more than their stock. And so M&A is picking up in Japan, but it's still got a ways to go. In South Korea, you see a steady rise in venture capital investing, $1.1 billion US. I'm surprised that didn't make it onto Ernst & Young's list of large venture capital investments. But where you see the most striking rise is Singapore. Singapore, for the last few years, not only has had a relatively sudden jump in the number of investment deals, right? 80 deals, but, $450 million invested, and according to the source of this graph, that accounted for 58% of all of the investments in ASEAN that year. So Singapore is definitely looking at growth in ASEAN as something that they see themselves as competitively advantaged at. That's the patterns in venture capital. Now, if you look at the patterns of people flow, yeah, entrepreneurs are everywhere. You'll find them in every population. The real problem is the growth stage. Getting people to come to work for your company is hard if your company is not named Sony in Japan, or if your company is not named LG or Samsung in South Korea. The quality, it's harder to get good quality people in a startup company or a rapidly growing company, especially if it's not your own startup company. One of the reasons is that the startup companies are not really offering the kind of lucrative packages that you get here. So stock options are a noticeable part of the compensation package here. If you're doing sales for a company, you can really make a lot of money if you exceed your sales quota. And for a rapidly growing company, there's a lot of people who are quite happy with that kind of job. One other thing is happening in the people function. I think it was last week, didn't June, our speaker from China last week, mentioned that Baidu, Alibaba, and Tencent are now siphoning off the good knowledge workers so that it's harder for startup companies to hire these people than it used to be. So you get these big companies who become prestige companies, they give better work conditions, and so it's harder to get people to work in a startup. There is still a social stigma about entrepreneurship in Asia. This is not just a fear of failure. What it is partly a very rational economic decision because of a very low mobility in the labor market. If you go to work in a startup company in Asia and it doesn't work out, you can't shrug it off and be, talking to people, to the recruiter next week like people do here. And you do get an awful lot of family pressure. And that kind of family pressure really rings home to me. My mom went through the Depression. I was a young child, and my mom went through the American Depression. She still asks me, "Are you okay, Richard?" Stability is a huge, goal for people who went through that kind of situation. And so post-war Japan, post-war Korea, post-Cultural Revolution China, of course the senior people in those countries are going to have a preference for what they see as a better route to success, a more stable route to success. It is a high career cost of failure for people, and what you don't see is the successful people also don't flow back into the system. Because we have such a sense of exits here in the States, the successful entrepreneurs flow back into the system and start another company, or they become a venture capital investor. How many people do you see who started a company and now they're talking from the standpoint of a VC or an angel investor? That is something that hasn't happened in Asia yet. These people would have to sell the stock in their companies before they could have the kind of finances to really get into investment like that. That does not put their knowledge back into the system enough. With regard to flow of ideas, entrepreneurial innovation is a very popular topic among every government in Asia. And I've met with most of them in the last year. I think that you see this real emphasis on tech transfer. Some of it's kind of scary stuff. If you tell a university that you really should be doing innovation instead of research, what does that mean? And, it does have a dangerous aspect if you start to try to develop too much business from a university. That may not be the most productive way to develop new business. Mentoring is not well developed in Asia. I think that a lot of it has to do with Confucianism. That someone who is the master should be imitated. And that's wonderful, but it's a one-way flow, really. The master shows how things are done, but doesn't really engage in dialogue with the apprentice. So I do think that that's an issue in Asian economies. I think that to a certain extent, there's also the concern about face. Why don't university professors in Asia do more aggressive consulting? You don't see it nearly as much, partly because if they say something stupid, the career cost of that failure is very high. It really hurts face. I think that certainly if you talk about idea flow, if the idea is a product, then if it's gotten to the product stage, market access is much more difficult in Asia than it is here, especially in the B2B sector. And this has to do with big company attitudes. They're not participating in open innovation nearly as much as they do here. And yeah, I think that if you don't have someone who's willing to buy your idea, it's much harder to get your idea out to the public. We have a much more rapid flow here as a result. So, takeaway points. Entrepreneurship in Asia is incredibly opportunity driven. Forget the stage of economic development. That's a remarkably widespread attitude. The people in Asia are still focused on the creation stage in this whole entrepreneurship process. I think they're not looking nearly enough at the growth and exit stage, and that also applies to government policy, and frankly speaking, it applies to the kind of research that's being done into entrepreneurship. What's next? You're still seeing a lot of independent kind of hub and spoke between Silicon Valley and individual Asian countries. So, with the exception of China, and everybody's interested in getting a piece of the growth in China, Thai is going to look at the Indian community and going to look at investments back in South Asia. You've got SAVVI, the Strategic Association of Vietnam Venture Investors, that looks at Vietnam. You've got the people who look at Taiwan. You've got the people who look at Japan. You've got the people who look at South Korea. It's very much hub and spoke. I have a feeling that we're going to start to see a lot more networking across borders in Asia, and young people who are used to hackathons, who are used to engaging each other through online media without being next to each other physically, may actually start to do some interesting things with kind of more network effect. So if we had to say there's a next stage, that's where I would kind of make a guess. So I'll call an end to my prepared remarks at that point. We've got a few minutes left for Q&A. Thanks for your attention. And the floor is open.
Why does the World Bank and the CIA have such difference?
Okay, it has to do with how you calculate the purchase power parity. That the idea is that you have a basket of similar goods and services, and what can you buy for a certain amount of money? So you have the problem of calculating that at one point in time, and if you look over a series of years, you also have the problem of, are you calculating in this year's currency or in a previous year's currency? You have to really be careful about putting this information together. The CIA tells you very clearly that all these numbers are 2013 numbers, and the World Bank is less clear. But I think that they revise their numbers a little bit more frequently than the CIA does. So, yeah, and that's good to remember about economics. You want to see the patterns and the trends, but you don't really want to get too detailed about it.
With the China economy, slow down, but the government push for the start, you can see it everywhere, right?
Yeah.
But it look like they hope that every young generation start a new company, and so when they can get the people to work for them, right? So what do you think about this China current policy?
Well, until recently, the growth in China has been so incredibly rapid that entrepreneurship was a relatively safe career decision. And even the big companies in the East, did you want to go to work for Foxconn or do you want to do your own thing? Right? If you're doing outsource work for somebody else manufacturing, that's not that interesting a job. And so I think that it was very attractive to large numbers of young people, period. Now, as things are slowing down, you're also seeing large companies having a noticeable percentage of available capital in China. And so that's a difference, that shifts things around quite a bit. And my sense is that China has been such a gold rush that it made economic sense to try to go out and be an entrepreneur. Now, as the East Coast slows down, what's going to happen? I really wonder if it's going to continue to shift into the Tier 2 and Tier 3 cities in the interior. Chengdu is very interesting. There's a lot of things going on. Wuhan, very interesting. So you're seeing that kind of a shift. And there's still an amazing amount of rollout that's possible in China, right? If GDP across the country is still only $9,800 per person, what will it be, when they get up to $36,000 or $39,000 per person? And so I think that right now, the government realizes that it really needs to avoid some of the capital traps that Japan and Korea fell into, where the first generation of very successful companies went global, but they became such powerful players in the economy that they were able basically to kind of push out a lot of entrepreneurial possibilities. And that led to slow economic growth. Once you go global, how do you get more growth, right? So China is trying to avoid that trap. And it's also still in the process of straightening out its just basic kind of commercial infrastructure. You know, how will the law be interpreted? We talked about this last week in the session here. If the crackdown on corruption indicates a greater consistency in the application of the law, that's great for everybody. I expect that to happen. The question is, how quickly will it happen, right? That's a great question. Larry?
Do you see any difference in attitude towards doing hardware and devices for entrepreneurs versus software and services seem to be more dominant here?
Partly because, you know, in a way that's exactly why you don't see so much innovation from Chinese startup companies. There's too much good business to do without spending the time to develop something advanced, right? Here, if you can make a lot of money developing an iPhone app and get into the market within a few months, why in the world would you spend the time to design a chip and then find some place to fabricate it and then find some group of people to buy it? It's where people perceive the opportunities. Right now, the opportunities in the valley are perceived in very fast division areas. And the big companies in the valley know very well how to use their positions to get into business lines that really would be hard for a startup to start without, you know, an amazing amount of resources. In China, the same kind of thing applies. Getting to market first with your idea is a very important competitive thing. And why sit around and incubate some technology for 2 years when you can be earning money this year, right? So I think that's a very good question. I think hardware is not going to disappear, but I think that the pressure on the hardware makers is to be together with the end users very early on. And the companies like Apple and Google and Amazon that know how to do this kind of system development will be more successful than the old style companies that only outsource what they have designed in-house. So I do think there's a lot of future in hardware, but it's harder. It's a more difficult play. Also a good question.
Startups, entrepreneurial places in the U.S., you often divide them into categories: business to the customer, like business to business, or business to consumer, or you divide according to category, like products or services or such. Is there, if you look through those eyes, is there any patterns in the Asian entrepreneurs? Are they more services, less products, more business to business?
Along with general economic development, you see a market increase in the percentage of the economy taken up by services. And, you know, so what is Accenture? Is that a services company or a software company? Services. And so I think that you do see more on the services side, but it all depends on the hardware and software, right? There will always be a place for it. It's just, how can you have the dynamics to have a good, successful company? Right? I think in the hardware area, that's a harder play than it used to be. You know, the old days when the people who made the microprocessor chips controlled the price of the computer. Kind of the opposite now. Okay. Go ahead, Rick.
Do you think patent law, IP protection, is a significant element or not in Asian entrepreneurship?
It is, but more important than that is how the law is applied. Well, I think the biggest issue in China has been that courts do not respect each other in terms of case law. So if this court decides a case this way, some other court may decide it a totally different way. Forget precedent? You got to be kidding. And that has had a negative effect. Just about every country in Asia now has a good IP law, a good IP law framework. The problem is how they're implemented. And that, I think China sees that it has to improve the consistency there. I really do think that's part of the corruption crackdown that's going on now. In places where corruption has been too big a part of the economy, you see a direct negative impact on GDP growth. And China doesn't want that. They want to slow down, but they want to manage it and keep it nice and robust, right? So I do think IP law is important. Another issue with IP, one of the things that's most sophisticated about Silicon Valley is knowing how much you can talk about and knowing what kind of discussions of new ideas you can have without violating somebody's intellectual property, even your own company's, right? And we're a very litigious society, and I think part of that is that we've all seen the examples where so-and-so, stole some background IP from somebody and started a company with it. And in general, people in the Valley are really smart about what they can say, and they talk. If you don't have a real good body of case law and how those things are interpreted, you're afraid to talk. And I think there's more fear of talking in Asia than there is here. It's still a newer system. Great. One more question? Go ahead.
How much of Asia's growth that you're talking about is more, excuse the language, but copycat as opposed to real
Yeah, okay.
growth?
That's a good question. I think that if you're copying an idea from one market into another market, that's not necessarily a bad thing. There are so many great business ideas here that just you really ought to take to Asia. And there are so many great business ideas in Asia that you really ought to take here. But the localization is really hard. Okay? I think that somebody who just tried to read a patent and copy the patent down and file that same patent in another country probably doesn't have what it takes to turn that into a profitable business. And so you really do have to give credit to that creative aspect of copying. Now, as you get a more advanced economy, there's more of a base inside your domestic economy that you might infringe. And that's what people really care about. So and what government IP law really cares about. So that you want to avoid infringement. In a more advanced economy, you really have to be engaged in more advanced research in order to bring something to market. Just because you'll get shot otherwise, right? So if you say what percentage, for the last 40 years, there hasn't been that much copying in Japan. For the last 15 or 20 years, there hasn't been that much copying in Korea. China's still engaged in quite a bit of robust copying, not only of overseas ideas, but we had a speaker in this series not too long ago who pointed out that there are 1,300 different versions of Groupon in China. So somebody brings in an idea and everybody's going to try to do the same thing. It's a huge country that's expanding so rapidly, you can still get away with that stuff. It won't last forever. Yeah.
That the T
TEA,
data you have.
right.
And given that they have such big numbers, I'm wondering, and with universities like this and Harvard and other schools in China and other Asian countries, and their patent numbers are huge now.
Yeah.
Do they have a, grassroots growth kind of rates in there?
Well, I do think that that's one reason the T rate tends to go down as an economy develops, but then it goes back up. And those countries have very well-advanced IP systems, right? Great questions. I tell you what. Yeah, okay, let's do it. Go ahead.
I actually just want to add one point to this copy thing. Just like in China, over 10 years ago, it's very popular to copy ideas from US to China. It's so popular. Even today, we still Chinese still do that, but not that as often as 10 years ago.
Yeah.
As a contrast, actually, China has already developed so much advanced in mobile internet or even payment or something like that. Nowadays, even US companies are trying to look at Chinese companies to see what they can copy. Like I know that in Twitter, they look at how Chinese Weibo, how they manage their micro blog, and they try to copy some model to US.
Yeah.
Maybe Facebook Messenger copy WeChat or something like that. Even so, I'm here starting my own company now. I'm part of Tea Party or Tea whatever.
Yeah.
And I'm copying one feature from WeChat to US. So that's something like a reverse copying right now is happening.
And that's fine. You know, this is legal. And this is how a lot of international business is done. So, you know, one value in looking internationally is to have the idea of what new opportunities there are. Thanks, everybody. We've got some refreshments outside, and I'll be happy to talk to people outside in a more informal setting. Thanks.